So next we're going to see about technical analysis. What is a technical analysis? Technical analysis is the method of share price movements based on the study of the price graphs or charts. So what price the product is going on the product, they will put a graph. On that graph, they will see how price is going, and they will put some charts and see what is happening. So these are the things we should see in technical analysis. The principle of technical analysis: market discount everything. So the what is the price and how the product price has been in the market, that is market price, and the market price discount everything. They will decision, they make decision for everything. Price moves in trend. So is it upward trend or downward trend? History trends and repeat itself. Usually the trend usually repeat itself. It will go up and down. M trend. You'll see candlestick analysis. This kind of history you'll see. Bull market, bearish market, everything you'll see. So theories in the technical analysis that usually we want to go through this theory. What are these theory? The Dow theory, Dow Jones theory, pilot wave theory, random walk theory, breath index. So the breath index, then volume of transaction, confidence index, relative strength analysis, odd lot theory. These are the theories which helps you to identify it, and we will evaluate it. So what is the argument of technical analysis, argument analysis, technical analysis? Everything is there. So we will see one by one. Okay. So what is the Dow theory? What is the Dow theory? It is originated by Charles Dow. This person created Dow theory. It is helpful for determining relative strength of the stock market. Relative strength of stock market. This helps to find. It is based upon the movement of two indicators DJIA and DJTA. So Dow Jones, IA and TA. The movement of the market divides into three classification: primary movement, secondary movement, and daily fluctuation. So based upon this, they will find this dojo theory. Elliott wave theory. It is found by Raphael Elliott formulated Elliott wave theory. It is based on analysis of 75 years stock price movement and charts. So 75 years data has been used to find Elliott wave theory. It defines price movement in terms of waves. It is always same in waves. The wave movement of the market price is same direction. As this theory, wave is classified into one: impulsive pattern, basic wave, and corrective pattern, reaction wave. So there are two types of waves are used to find this market, whether it is impulsive, basic, or reactive wave. You can find this is Elliott wave theory. In random walk theory, what is that? It state behavior of a stock market price is unpredictable. Yes, that is the past price trend do not reliable predict future price movement. So past do not say what is future because the price trend represents statistical expression of past data. So you can't believe in past data. So then comes up the random walk theory. So what are the market indicator we want to see is breadth index. What is that breadth index? It's computed by dividing net advances or net decline in market by number of issue trades. So what is a traded issue? From that, we dividing the net advances and net decline, we will find this breadth index. It's either support or contradicts the movement of Dow Jones average. From the Dow Jones average, it will breadth index says it will support it or it will contradict it. That is what do. So Dow Jones theory and breadth indexes are it both can be used. Volume of transaction. The volume of share traded in the market reflects how the market should behave in near future. If every the volume is high, so demand is high, na, price will fall. And reason for the demand, everything will see usual demand, what will be, and what is the current demand, that will see. Confidence index example loan. So how confidence it is. Relative strength analysis. It suggests that the price of some securities rise relatively faster in bulk market or decline more slowly in bear market than others. Some security exhibit relative strength. So some security will grow fast but fall very slowly. Some will go slow but fall fastly. So these all based on the relative strength, relative strength analysis. Through that we can find. So this shares we can invest, so we can have a reduced risk. We share if we invest, we may have a higher risk of price fall. These are the thing. Odd lot theory. What is an odd lot theory? It assumes the average person is actually wrong. Hence, wise course of action is to pursue strategies contrary to population opinion. So, a popular every indicator say buy now, based upon the odd lot theory, you need to sell. Every indicator says sell now, based upon the odd lot theory, buy. This is what odd lot theory. The evolution of technical analysis, what it in rational, well ordered, and well efficient market, technical analysis may not work well and perfectly. So the this technical analysis may not work perfectly, usually not. However, it imperfection with characters of real world, technical analysis are more useful. Sometimes it's very useful when the argument for technical analysis helps identify that trend early. So what will be the price upward or down? We can find with this trend. It helps to detecting shift in demand and supply. So the demand supply chain we can be able to guess it with this technical analysis. Argument against technical analysis. It is favorable, it's unfavorable, what they say. Technical analysis is not able to provide convincing explanation for tools used by them. So they are saving many formulas. Whether it is a proof of evidence, no, no, it is not a proof of evidence. Evidence is supported of random walk hypothesis, cast a shadow on it. It is like a random walk. Like you can't stop the person by stamping on its shadow. Na? It's like a wish. You can predict how the shadow will be always back or front. Based upon the light will change. So you can't find of stomping the shadow, you are not stomping a person. So such a thing it is. This is technical analysis. So fundamental analysis you should take care, but technical analysis you should not. But it will help you to find whether the market is up or down. That's it.